Morning.
Good morning.
Oh, what a welcoming crew. Welcome to the New York City Retirement Systems Common Investment Meeting for March 20th, 2019. We're going to start by calling the rolls of the different boards, and let's start with the Fire Pension Fund. Mr. Dunn.
Good morning, Mr. Adler.
Good morning.
For the mayor.
John Adler, present.
Okay, for the controller, Scott Stringer.
Jennifer Konovitz.
Okay, for Commissioner Jiha, finance. For the UFA, Mr. Gerard Fitzgerald,
Leroy McGinnis with Gerard's proxy.
Mr. Leroy McGinnis,
Present.
Mr. Edward Brown.
Here.
Mr. John Kelly.
Present.
Mr. Peter DeVita.
Here.
For the UFOA, Mr. Jack Kelty.
Present.
Mr. Liam Guilfoyle.
Here.
Mr. Paul Mannix.
Here.
And for Fire, Commissioner Daniel Nigro.
Tara Brown for Commissioner Nigro.
We have a quorum.
Excuse me. Thank you, Pat. Complete. Oh, good. I better find my voice.
I'll save him.
Kevin Holleran, could you please call the roll for police?
Good morning. Representing the PBA,
Joe Alejandro.
Juan Spizzaretta.
DEA,
Michael Palladino.
SBA,
Anthony Bradley, designee Mons.
LBA,
Steve Bradley, designee Lutarco.
CEA,
Chris Monahan, designee Roy Richter.
Commissioner of Finance,
Cynthia Collins for Commissioner of Finance, Jacques Jiha.
Mayor,
Shuman Ray for Mayor Bill de Blasio.
Comptroller,
John Dorsett, designee for Control, Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, designee for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. Let's move on to teachers. Mr. McTeague, is it you?
It is, John. Thank you. John Adler.
Hey, present.
Thomas Brown. Here. David Kazansky.
Present.
Lindsay Oates. Deborah Penny.
Present.
Susanna Vickers.
Here.
Thank you. We have a quorum, John.
Thank you, Thad. And Nicers, Melanie Winnery.
Good morning. Chair, Mayor's Office.
John Adler, present.
Controller's Office.
David Jenner for Controller, Scott Stringer.
Public Advocate's Office. Borough President, Manhattan.
Aljo Rafael Bonilla for Manhattan Borough President Gail A. Brewer.
Borough President, Brooklyn. Borough President, Bronx.
Mirtha Camille Sabio for Bronx Borough President Ruben Diaz Jr.
Borough President, Queens.
Alan Swisher for Queensborough President Melinda Katz.
Borough President, Staten Island.
Isaac Gordetsky for Borough President James Otto.
International Brotherhood of Teamsters.
Lawrence Bosley for President Greg Floyd.
Transport Workers Union.
Dave Kassman for TW Local 100 President Tony Otano.
District Council 37.
Ray Santander for Henry Garrido.
We have a quorum.
Thank you. And for Burrs, Daniel Miller.
I'm here.
Mr. Rich,
Mr.
I didn't
Adler,
see you
good
there. Please.
Well, I try not to be seen. We are not represented by any trustees today at this common investment meeting. We will administer this business at our next Board of Trustees meeting, which is March 27th. All are invited.
Thank you, Sandy. Okay, with that, we will turn it over to Alex Donier for this quarter's fund performance overview.
Thank you, John, and good morning, everyone. Happy spring, or at least in a few hours it will be. So today, just as a reminder, we're here to present the quarterly performance for the fourth quarter of calendar 2018. We have organized this presentation into two sections. I'll present fourth quarter returns for the systems, and Miles Draycott will present the risk report and review risk metrics for the quarter. You'll recall that Mike Haddad last quarter last month in the February CIM presented the market overview, so he will not be presenting today. However, we did want to remind you of the comments that Mike did make last quarter. So I'm starting off with a slide that Mike presented at the February CIM showing fourth quarter returns. And as you'll recall, for the markets, all equity markets globally were down significantly for the quarter, as you can see in that third column from your left, with U.S. equity markets down more strongly than EAFE and emerging markets. We did have positive returns in U.S. Treasuries as yields were lower in the quarter. And certainly just wanted to frame our discussion on fourth quarter quarterly results for the systems by just reminding you of what the markets did in the fourth quarter. So certainly keep that in mind. However, before I do turn to those fourth quarter results, I just thought it'd be important just to remind everyone and point to the fact that there's been a strong rebound in the markets in the first quarter to date. If we look at just equity returns globally through Monday of this week, I think is when we put this together, the Russell 3000 is actually up 13% through Monday for 2019. The MSCI World ex-US is up 10%, and the MSCI Emerging Market Index is also up 10%. U.S. Treasury yields are roughly unchanged for the quarter. Now, why is that? Why have we seen this sharp reversal, almost a V-shape recovery again from the trough that we experienced? I think the U.S. markets hit the trough on December 24th of last year. A few things. First of all, it's what we're calling the Fed's dovish pivot, which Mike alluded to and went through in detail last quarter. So the Fed is signaling a pause in interest rate hikes and the ending to quantitative tightening, most likely sometime at the end of the year, fourth quarter of 2019. As you know, the Fed is meeting today, the last day of the meeting, so there'll be some announcements to be made. And most likely, I think the expectations for the market is that interest rates will remain unchanged. And there's been dwindling expectations as to whether there'll be any interest rate increases this year. There's still some who believe there may be one interest rate increase this year, but potentially, given some maybe confirmatory remarks, it may be signaling to the market, as I just said, an end to interest rate increases at least for the year. I think in addition, what's been impacting the markets at the beginning of this year has been U.S.-China trade and the trade war and trade discussions. I think as you've been reading, the market has been discounting meeting an agreement sometime now in April. I think that has moved from timing originally in March, so now the market believes and seems to be indicating that a trade agreement with China should be able to be reached by the end of next month. So certainly fears of a diminishing trade war, escalating tariffs, and taking that off the table, so to speak, has been positive for the markets, the equity markets in particular. I think the other big issue or big event that is impacting the markets positively to begin the year has to do reduced concerns on China's slowdown. Certainly a big worry heading into late last year was global economic slowdown, China in particular, and some of that is easing because China is being very active in trying to reverse that or certainly mitigate slowdown in their economy. They've actually enacted 55 targeted fiscal stimulus programs to try to boost their economy. So the mitigation of kind of meaningful China slowdown is also having a positive impact on global equities. So all that put together, as I mentioned, suggests that at least through this week, we've had a strong recovery to the year. So next quarter, if these results hold through the end of the month, which would be the end of the first fiscal quarter, we should see those benefits reflected in the returns to your portfolio when we return in the June quarter to discuss first quarter of 2019. Now, With that bit of good news behind us, back to December. And we'll begin here with the systems aggregate AUM for the period ended December 31st of 2018. You'll see that in the aggregate, the systems have about $187 billion in aggregate assets. And that is actually down, you may recall, from the $200 billion in aggregate assets that we reported in the September quarter. Now, for the fourth quarter, and you'll look at this page where we go through some of the returns and focus you on the third column from the left, which is returns for the quarter. Returns for the quarter range anywhere from negative 5.92% for NYSERS to quarter. But you'll notice that the systems results did outperform the index portfolio. Notice that the systems results did outperform the index portfolio, that you see that towards the bottom of the page, the 65-35, as we call it, public market equivalent portfolio, which was down even more significantly than any of the individual systems. And that is primarily driven by that index, particularly the equity portion of it, the 65%, being more heavily weighted towards equities, and U.S. equities in particular. If you look at the systems generally, it's about 50% exposure to equities, and U.S. equities is closer to about 30%, versus this index that we show you here being 43% equities. So in a meaningfully down market, and us having less exposure to that accounts for us outperforming that index. You'll see also that for the fiscal year numbers, which would be July through December, and the one-year trailing, the systems are also negative, but also outperforming as well the index portfolio. But more importantly, when we look at the 30-year trailing number to the far right, so the longer dated time frame we have in this slide, importantly, the systems are not only positive, which is important, but each system is above the assumed rate of return of 7%. So that is important as we are long-term investors. And I will also, as I always mention, some of the comparisons here are against some of your larger peers, the system's larger peers, so other large public pension plans as reported by Tux, where the systems have outperformed in all the periods we show here. But I do remind you that Tux reports figures and returns gross of fees. So let's go through the portfolio in a little bit more detail. On this page, we show performance for each system across their respective portfolio for the fourth quarter versus the custom benchmark for each system. And the horizontal line, which you'll see there represented at 171 basis points, is the assumed rate of return, or 7% for the quarter. So obviously our long-term goal is to exceed the assumed rate of return and drive excess return through manager value add. However, we did not meet that expectation in the fourth quarter. Nonetheless, all the systems, with the exception of BRRRR, which slightly underperformed, did beat their respective custom benchmark for the fourth quarter of 2018. And you can see that on the table on the far right of this page, where you see kind of the excess return versus the benchmark. They're all slightly positive. BRRRR is just marginally negative there, 1 basis points below. So on this page, as we are accustomed, we break down the components of the total portfolio returns that are contributing, in this case, to the outperformance versus each system's custom benchmark. And you'll notice that most of that outperformance is primarily being driven by asset allocation. Although we did see, if you look at the far right hand of the page, and did experience some manager underperformance, but it's primarily been driven, the overall outperformance by asset allocation. And that's attributed to the tilts that we've taken in the portfolio, and specifically they are underweight, and the system's underweight to U.S. equities. So being underweight U.S. equities in a very down market that was the fourth quarter was a net positive. So you mitigated, negative or even more negative returns in the fourth quarter. The tilt here were positive. Now, BRRRR did have some measurable manager underperformance. BRRRR will see that represented on the far right-hand side of the page, that negative 92 basis points. In the green, that is primarily in your EFI portfolio, where BRRRR has all active managers, and Baillie Gifford, one of your managers there, underperformed in the quarter. So that's what's driving that performance. So let's disaggregate equities, beginning with domestic equities. So for the quarter, all systems performed closely or just slightly below the benchmark, as you see to the far left-hand side. For teachers, you were right on top of the benchmark. For NYSERS, also above the benchmark. Wellington small cap outperformed for NYSERS. For police and fire, slightly below the benchmark for the quarter. Iridian was the biggest detractor to performance in the quarter. And for BRRRR, Wellington mid-cap here is also one of the managers that detracted from performance in the domestic equity portfolio, U.S. equity portfolio. So now looking at EFI for the quarter, all systems with the exception of BRRRR, well, first of all systems underperformed. Let me start there. But I was going to say, for all systems, excluding BRRRR, the main drivers of that underperformance for the quarter were Baillie Gifford and Causeway. They were the biggest detractors of performance in the quarter. And while Walter Scott, I will mention, actually outperformed in the quarter. For BRRRR, the underperformance was solely Baillie Gifford. And that was the biggest detractor. And Baillie, just spent a little time on them, did underperform, caused by some of their specific stock selection in the quarter. Think of companies as M3 SoftBank were, no pun intended, soft in the quarter, and that led to underperformance there. And Causeway was also, as I mentioned, a detractor of performance, primarily driven by their UK holdings and UK exposure as continued Brexit uncertainty has hit that portfolio. I will note, again, for Baillie, that over the longer term, as you can see represented on the far right-hand side of this page, has been a terrific manager for the systems and has outperformed and significantly outperformed over the 3-year period. Now moving to emerging markets, all systems, with the exclusion of teachers, which had slight outperformance, did underperform. For teachers, that outperformance was Lazard. So Lazard outperformed for teachers, while Acadian underperformed a little bit for teachers. Moving on to NYSERS, Acadian was also a big detractor in the quarter in your EM portfolio. For police and fire, it was Acadian and Baillie Gifford were the biggest detractors, while Parametric did outperform for the quarter. And for BRRRR, the sole active manager, Acadian, underperformed for the quarter in emerging markets. So moving to fixed income. So in the quarter, as I mentioned at the onset, yields for the fourth quarter fell across all maturities. Given our underweight to the long end of the curve, we did underperform for the quarter, as longer end maturities, longer end of the curve are more sensitive to rate changes than the front end. I also mentioned, as you'll recall, we do have underweights in investment grade credit and mortgages, and that actually helped performance. Said a little differently, it mitigated generating even more negative returns, as all segments and all managers in investment grade credit and mortgages underperformed for the quarter. So being underweight there did help. High yield. So high yield returned negative. Actually, it was a negative return for the quarter, negative 4.23%. A little better than the benchmark. The benchmark was a negative 4.5%, so we outperformed in the aggregate the benchmark by 31 basis points. And the portfolio here did benefit from its core and defensive positioning. It's important to note here that no high yield or bank loan sector posted a positive performance in the fourth quarter. It was a very tough quarter for high yield. I'll mention energy, which is 15% of the index, was the worst performing sector in high yield, as oil prices were down over 30% in the fourth quarter. Airlines were stronger, but they also were negative for the quarter. Airlines being the strongest segment for the quarter, but negative. And we should mention that in a reversal of a trend that we mentioned last quarter, higher quality BB has finally outperformed lower quality CCC in the quarter. So we've noticed that. That's where being a little defensive has certainly helped. Moving on to bank loans. Kind of similar story. In bank loans, the program returned in the aggregate a negative 3.18%. That is actually slightly below the benchmark, the Credit Suisse Leveraged Loan Index, which returned a negative 3.08%. So we underperformed in aggregate by about 10 basis points. Most managers in the bank loans portfolio performed as expected. I would highlight Barings, which is Burr's only bank loan manager, underperformed significantly actually in the quarter due to some poor credit selections, particularly in energy. This again, I think overall, albeit negative, benefited, and teachers, I will say, that met the benchmark in particular did benefit from its defensive positioning in bank loans. And I would highlight two of your managers, Wells and Voya, for particularly leading to that result in bank loans for the fourth quarter. Again, similar to high yield, no bank loan sectors posted a positive performance in the fourth quarter. So moving quickly to ETI, so economically targeted investment. ETI did outperform for the quarter, as you see here to the far left. Just a reminder, it's really the duration in the ETI portfolio. As you know, the duration in the system's ETI portfolio is actually longer than the index. So you would expect that in a lower rate environment, as we experienced in the fourth quarter, that you would have outperformance in the portfolio. Hedge funds. Let's move on to hedge funds. So here we have hedge funds for police and fire. For the quarter, hedge funds in the aggregate did outperform the benchmark. However, overall returns in hedge funds were negative. And what I do in the next couple of slides is just disaggregate the performance of hedge funds between the four strategies that police and fire are invested in hedge funds and the tactical trade that was executed in the second quarter of 2018. And the performance of that trade. So let's start with the hedge fund performance less the tactical trade, so without the impact of the tactical trade. So for the quarter, hedge funds did outperform, as you can see, the benchmark. So police and fire, negative 1.7%. But the benchmark was down a negative 4.6%. So there you did have a meaningful outperformance in the fourth quarter. And if you look at the fiscal year-to-date period, similar story, just marginally negative, but meaningful outperformance. And over a 3-year period, positive over 5% performance returns for police and fire, over nearly a 300 basis points outperformance versus the benchmark for the 3-year period. Now let's look at that tactical trade and how it's done so far. As a reminder, police and fire in the second quarter of 2018, as you recall, you reduced your U.S. exposure by about 1%, and that was moved into hedge funds and into 4 managers in hedge funds. That tactical trade, although it is negative, so if you look at the middle column, the fourth quarter, you'll see that the trade itself has returned a negative 4.4%. The benchmark, the Russell 3000, was negative over 14% for the quarter. So you outperformed meaningfully the benchmark by 10%. So that was a positive trade there. Private markets. So private markets, we begin with the OFI portfolio. OFI, as you can see here, has outperformed the public market equivalent, and it is slightly behind the benchmark, which is the public market equivalent plus the 300 basis points illiquidity premium, here represented by that line that says 300 basis points target, so just slightly below that. Now the program, the OFI program, the portfolio, has very wide dispersion of returns, and I think what that certainly tells you in the way the team has planned this portfolio, in that it's indeed very well diversified, and it's not just an alternative credit exposure. I guess the other comment I would make on this page is that while OFI returns are very company-specific, the managers here were able to take advantage of the market downturn. So what we witnessed in December is that while the markets were meaningfully down, we saw a drawdown of capital to be able to deploy into these tough markets in December. So again, OFI managers doing what we would expect, which is being opportunistic when they see opportunities, which they saw at the end of last year. So now turning to private equity. As a reminder, the next several slides, beginning with PE, is reflecting third quarter of 18 performance as performance is reported on a lag. I guess the highlights here is that PE continues to experience improvement. Here in the third quarter of 18, one thing that you can't see on this slide, but I will highlight, is that every system is now showing net IRR. So net IRR since inception for each of your entire portfolios above 10%. So that is a strong number, and the first time certainly that we have been there. And as we've been reporting, we have seen sequential quarter-over-quarter improvement in the PE portfolio for each system for well over 2 years. However, when you look at the overall portfolio, which is what's really represented here, there continues to be a lag of the overall portfolio versus the PME benchmark, which again is the public market equivalent, and the 300 basis points illiquidity premium. And that is still driven by your legacy portfolio. If you look at the legacy portfolio, it continues to be an anchor, but importantly, your primary managers, as we have discussed with each of the systems, continues to be a bigger share of your portfolio. So we're very encouraged by those trends. So here we just break down PE performance a little more granularly. You're used to seeing this slide. And just as a reminder, the y-axis on this chart measures the PME spread, or the percentage of outperformance or underperformance versus the public markets. And then we break out performance into the pre-2011 period and the post-2011 period. And that point of demarcation, as you know, is two things: the hiring of your new private equity consultants, and also changing of the strategy in PE post-2011. Yes?
And the hiring of you. Whatever.
And certainly the BAM staff and the work that they have that the team has done on your behalf together with your consultants. But you'll see there to your far left that in the pre-2011 period, the portfolios meaningfully underperformed for that period of time, which for most systems, you've been investing in PE since the late 90s. But if you look at post-2011 period, the systems in aggregate have consistently outperformed in most vintages, and in some vintages are well ahead the PME benchmark, the public markets plus the 300 basis points illiquidity premium. I will draw your attention to 2015, because you will notice that 2015 is a little bit of an anomaly. There are actually a couple of managers in that vintage in the portfolio that are off to a slow start. EQT and Warburg Pincus, one of the most recent funds, and so that has led to some underperformance versus the PME, which frankly is a very tough PME to beat, given what the public markets have done, but nonetheless slightly below. For teachers, the reason why teachers did outperform in that 2015 vintage is that you're not in those funds. So in 2015, you didn't make any private equity investments in that vintage, I should say, which is why your bar is still outperforming for the funds that you did invest in. That being said, for those two funds that are a little bit slower out of the gate, it is very early in the fund life of those funds, and we have expectations that those funds should return not only strong absolute returns, but strong relative returns to the public market equivalents. So let's turn to real estate, and we begin with the core portfolio. So looking at, again, Q3 of 2018, core investments are outperforming the PME benchmark for all systems with the exception of NICERS, which slightly underperformed since inception. Again, I always remind everyone the differences in returns by system can be attributed to pacing, manager selection, and commitment sizing to funds where the systems do overlap. Now, teachers, police, and NICERS and fire invested in core real estate in 2006, and I think what drags down NICERS, again, as a reminder, is that you had a 6% allocation to real estate at the time versus the other portfolios that was closer to 3%. So you were more exposed to some of the tougher managers and funds during that period, and that's what accounts for that difference for NICERS. And again, BRRRR benefits from timing, and their first core investment was in 2010. So non-core real estate, good, strong story here as well. Looking at the third quarter results, so these are since inception returns through the third quarter. All the systems are outperforming the PME, the public market benchmark. Now, across the portfolio, the systems, excluding BRRRR, certainly have been affected by some legacy investments, same as in core. So these numbers could have been even stronger in terms of outperformance. So there's been some drag there, but importantly, all the systems are performing strongly against the public market equivalent. And again, disaggregating the non-core real estate performance, a similar story to private equity, where we look at the pre-2011 performance and the post-2011 performance, and importantly, as you tweaked it, and we have changed the strategy in real estate together with your consultants. You can see the very strong outperformance that this portfolio has experienced over the last 7 or 8 years post-2011 period. And last but certainly not least, we have infrastructure. The infrastructure portfolio continues to perform very strongly. I thought I'd share with you just some interesting statistics as to the development of the infra portfolio. As of the third quarter of 2018, the infra portfolio is approximately 44% funded. It's actually diversified across 93 companies. And you have exposure primarily in North America, about 51% of the exposure is in North America. 35% is in Europe, the balance rest of world. And from a sector perspective, you have 30% allocated to transportation infrastructure, about 24% is renewables exposure and infrastructure, and you have a 19% exposure to midstream energy and infra. Performance continues to be very strong here, and obviously exceeding not only the PME benchmark, but also the IPS benchmark, which is a CPI plus 400 basis points. Again, just disaggregating it and looking at specific vintages, same story, and really strong performance from these managers. So the systems are enjoying strong returns. There's been some early realizations that we've discussed in the past in some of your infra funds that the systems are invested in, and the investments that are still in the ground, as we say, that are unrealized, have experienced some meaningful uptick in value. So all of that leads to the strong performance you see on this page to date for the infra portfolio.
Question.
Yes, John.
Why is 2015 blank?
Because you did not invest in a 2015 vintage year fund.
Okay.
So that is why there's no information for 2015.
Got it. Thank you.
And that concludes my remarks on fourth quarter performance, and I'll take any questions.
Any additional questions for Alex? Okay. Thank you, Alex.
Well, thank you. I'll turn it to Miles Draycott.
Hello, good morning. So I want to talk a little bit today about obviously the risk of the portfolios, the systems portfolios. But before I do that, I'm going to just say a few words about a couple of enhancements we've made to the process which generates the risk reports, and a couple of developments that have affected the risk team. Sorry, I'm going to talk about the, before I talk about, jump right into the risk of the portfolios, I want to spend a few minutes talking about some of the enhancements we've made to the process that generates the risk reports and a couple developments that have impacted the risk team. The first thing, when I refer to developments, we've unfortunately lost two crucial members of the risk team. Our Bulgarian contingent resigned en masse. Mr. Dotov and Radev have left us, which is a crying shame. They were wonderful individuals. But anyway, we are hard at work at replacing them. We've hired a new senior investment analyst and are, I think, closing in on a senior risk officer. So anyway, on to the progress we've made. The most significant thing we've done is we've now loaded all of the holdings of your alternative managers into the MSCI application. So that's all the private equity, private real estate, infra, hedge funds, and OFI. With that having been accomplished, we can now generate truly comprehensive risk reports. So risk reports that look across both the public and private markets. And in fact, the risk reports that have been uploaded to Convene include that analysis across the entire portfolio for each system. The other thing to note is that we now have kind of a new high-level risk report, which I'm going to spend a little time discussing. It attributes the risk of your portfolios to a very sparse set of factors, what we call macro factors. So we're going to spend a little time talking about that after I go over what you're familiar with, the cover page of the Blue Box reports. And then the final thing that I want to note we've been working on, we're not going to get into much detail on today, but I expect it to become a companion piece to our risk reports going forward. And that's a separate package, which MSCI calls return attribution. So really, the risk reports should be viewed in conjunction with what happened to returns. And we want to understand, did the risks suggest that we've reported to you suggest the return that was actually realized. So really, in any kind of trading situation, you really need to look at both sets of reports. They're companion pieces. Going forward, we're going to spend more time talking to you about return attribution. If not in May, when I'm going to give something of a status update on what risks projects have been, certainly by June. So this is the cover sheet that we've gone through before, and there's just a couple changes to it. I'm not going to go through all of the Blue Box reports today. We've done that previously, so I've just really taken the cover page from the Blue Box reporting package. We're just going to spend a few minutes on this today. The most noteworthy thing is probably the small box I've drawn a circle around. In that box, you'll notice that there are now private asset classes have been included. I've drawn your attention to one small factoid. If you look at private equity, we now report the risk of that. It's quite large relative to its percentage of NAV. It's about in this case, over 12% of the risk, yet it's a little under 7% of the actual asset allocation. The other thing, perhaps, to note, I'm echoing something both Mike and Alex have talked about. Once the total risk of your portfolio, which is 6.67%, or this portfolio, that's actually lower than the benchmark risk. That is completely a function of the fact that we have tilted underweight to U.S. equities, to some extent credit and rates. So you see that difference between the risk of the benchmark and the risk of the portfolio. The other thing that suggests the portfolios are somewhat defensively postured is the fact that the portfolio beta is less than 1. That's another indication that as I say, the portfolios are somewhat defensive. So on to this macro factor report, which I want to spend a little time on today. We're trying to make the risk reporting, integrated a little bit more with what you hear from Mike. So for that reason, and because they're now available, we're also going to be talking about a risk report that attributes the risk of your portfolios to these 6 macro factors. It's probably worth reminding you that at the core of the BarraOne risk application is a factor model. So in the case of MSCI's factor model, it's pretty comprehensive. You can attribute the risk of any investment or the entire portfolio to imagine a pyramid of hierarchy of factors. At the base of the pyramid, you can attribute the risk of your portfolio using the lowest level to 3,500 factors, so excruciating detail about why the portfolio might have changed in value. As you sort of go up in the pyramid, the very top layer, the most sparse level of the hierarchy, are these 6 macro factors. And they actually they explain a surprisingly high percentage of the risk of the portfolio. And we'll get into exactly how much, basically, in the next slide.
Excuse me. I wanted to ask Miles over
Sorry, where are you
here.
coming? Oh, sorry.
Sorry to interrupt, but I wanted to ask a question on the previous slide on private equity. It's 6.9% of NAV, but 12.35% of total risk. How is the risk assessed on that, given that private equity is, thinly traded or not traded at all, comes to market, only once every so often years? So what is risk? How is risk defined there?
That's probably a longer conversation we're happy to have. MSCI has a technique by which they de-smooth the reported quarterly returns and kind of imply a volatility of the private equity portfolio, which is they imply a volatility which is higher than that would be realized if you just look at the quarterly returns. And I can send you a paper on how they do that. It's not a trivial. Yeah, I better. Is that okay if I get back to you on that?
You're making my mouth water.
Okay. No, happy to provide that, but it is a long. It's a.
Thank you, and I apologize for the interruption.
No. It's a great question. Unfortunately, we don't have time to answer it right now, and yeah, it would. Yeah.
Miles, you should probably send that paper to all the trustees, even if the rest of us, our mouths are not watering.
Okay. No, we're happy to do that. It's an excellent question, but as I say, it requires a long answer. So here, this is, in future discussions, I want to spend more time on the basically return attribution. We're not able to do that today, but I just wanted to put this sort of simple chart up. This is just the 6 factors, the 6 macro factors. You see the risk that each of them contributes to your portfolio, and you note that equity is obviously a very high percentage of the total risk, over 84%. The other thing that's noteworthy is because of if you remember the motivation for the long treasury position that we've accumulated was the fact that it was negatively correlated with the portfolio. That's the reason you see the rates factor actually is a negative risk. In other words, it's reducing the risk of the portfolio. Hence, that's a result of this negative correlation, which is in fact what caused us to make the investment in long duration treasuries. The factor returns these are not a function of MSCI's model in this reporting cycle. These are essentially my estimates. They're quite likely to be accurate in the case of equity, credit, inflation, and rates. There's a little bit of guesswork that's gone into pulling together what I refer to as pure alts and real assets. But anyway, in future, when the model spits these out, we're going to go into a lot more detail in terms of attributing the portfolio's return to factors.
Miles, I just wanted to ask.
Who are you?
It's a great question. Let me think about the Dave Kazansky teachers. So with a chart like this, I guess, as we're reconsidering our asset allocation, how would a chart like this kind of guide us? I guess, are you comfortable with the amount of risk in these different areas, or how should we be thinking about this when we're going forward?
This, I guess the broadest thing, we're going to get to it in a slide or two, is one of the points I'm trying to drive home as we all become more familiar with factor-based risk reporting is there's a huge difference between asset allocation to a particular investment and its contribution to the risk of the portfolio. So, there's and I think Mr. Adler's arranging a talk soon on risk budgeting. So there is more we can do in terms of understanding the asset allocation process. I'm not as capable of predicting market movements as others in our company, so I would hesitate to express a strong opinion as to, what the weight should be at this point. If you ask me personally, I don't own as much equity as you do, but.
You mean you don't have $186 billion?
I meant as a
Is that what you mean?
percentage of my minute net worth.
Thank you.
Michael? Mike Palladino from the Detectives. Are you telling me that this risk assessment is really specific to our portfolio and not just a general risk factor report?
That's a great question. The risk contribution is the contribution that each factor is making to this portfolio. The factor returns are more what are the factor returns in the market. Okay. Sorry for the wild gesticulation. Given that introduction, this is actually this macro factor risk report that I referred to, and there are a couple things that I want to draw your attention to here. One is basically repeating something you've heard from Mike and Alex. If you look at the box that I've drawn around 4 of the bar charts in the upper left, you see that the yellow lines there, that's the benchmark's exposure to a factor. Okay, the blue line is actually your portfolio's exposure to a factor, and you notice in the case of 3 of those 4 factor exposures that the benchmark is significantly more exposed to the factor than your portfolio. So that again is indicative of the defensive tilts that have been taken. So we're underweight essentially U.S. equities, long duration treasuries, hence rates, and to some extent credit. So that's again indicative of the underweights in your portfolio relative to the benchmark. The other thing that we see here is the total, the bottom, right there we draw out the total risk of the portfolio, which is about 6.67%, and we note that the contribution to total risk, sorry, I misspoke. We see that the equity factor is contributing 5.59% of the risk, and that's about 83.85%.
Can't hear you over here.
I apologize. I'll stop. Just the equity factor is contributing 5.59 to the total risk of 6.67. That is about 83.8%. So again, a majority of the risk is coming from the equity factor. The other thing that I want to sort of draw out in this chart is what we call active equity factor risk. That's quite low. Okay, that's only about 0.25. The total active risk of the portfolio is about 1%. Equities are only contributing about a quarter of that. So that makes intuitive sense if you think about the system's portfolios. We have an enormous exposure to the equity factor. However, the equity asset class is, at least in the U.S., largely passively managed. So big exposure to the equity factor, relatively small exposure to active equity risk. Yeah. So on this table, I basically want to draw out a couple of things. The first is a point that I made earlier, which is that there's a huge difference between the weight of an asset class and its contribution to the risk of your portfolio. So in this, and we're going to, and then the other point I want to make in with this chart is that you can attribute the risk contribution of an asset class, largely attribute to just these 6 factors. So if we sort of look at the left-hand side of the chart, we have a listing of the asset classes. We've got the market value in each asset class. We've got the weight, so just the market value of the asset class over total NAV. And then we look at the percentage of the risk which that asset class is contributing. So 100%, recall that's 6.67%. And then we look at the percentage of that risk, that total portfolio risk, which is coming from each asset class. And then the columns to the right of the red line, those are the attribution of that risk to each of these macro factors. And I should also mention that there are two columns on the extreme right, and those columns are basically residual terms. And there's two types of residuals. There's kind of factor risk not explained by the 6 factors, but that the model can explain if we went to a more granular level. And then currency is also thrown in there. That's the column on the extreme right. So you have numbers as high as 7% there. The other column, the second from the most extreme right, is a pure residual risk. That's stuff the model can't explain, and that, as you see, is quite low. Anyway, on to the main points I'm trying to drive to with this chart. If you look at public equity, you'll see that it's 46% or almost 46.5% of the by weight in the NAV of the system. But you note that it's about 78% of the risk. But then if you look at the equity factor, you realize that it's about 84% of the total risk. So that's saying that we have equity risk in many of the investments that the systems are making. Private equity, all of these asset classes have a component of equity factor risk. And then and as I say, if you go across the columns on the right, they'll sum to the total portfolio risk. So it breaks it out for you. Where's the risk coming from in the portfolio? So much as I said that in future we want to explain to you where returns came from by attributing them to factors, that's when we develop these portfolio return attribution reports. What we can do now is explain to you where the change in risk came from. So what we see in this chart is that the total expected volatility of the portfolio actually went up in the quarter, went up by 32 basis points. And the point of this chart, and so at the top of the page, I remind people how risk contribution is calculated. So the risk contribution of a factor is a function really of 3 things: exposure, correlation, and volatility. So I've just noted that the risk went up by 32 basis points on the entire portfolio, and we're trying to explain that in this chart. It turns out that exposure to factors during the quarter actually went down. Correlations also went down, but those trends or those movements, if you will, were swamped by the change in volatility. And the change in volatility came from one obvious place. It's the equity factor, which went up by 57 basis points. And that's all this chart's saying. Correlation and exposures went down, but volatility jumped up. This is the final page. And the point of this page is just to shed, again, a little bit more light on why the equity factor is so dominant. So again, we have the formula. How do we determine the risk contribution of a factor? Exposure, correlation, and volatility. In the upper chart, we see basically the inputs to that formula for equity. And we note that the equity factor exposure is high. What's equity factor exposure? It's just the NAV of investments you've made that are exposed to the equity factor over total NAV. So that's like 54%. The correlation between the equity factor and the portfolio is quite high, 95. And the equity factor volatility is also quite high, about 10.7. So if you grind through that, you get to the 84%-ish risk contribution of the equity factor. The purpose of the chart, on the covariance chart on the bottom there, is just to point out that several of the other factors are quite highly correlated with the equity factor and with the return on the portfolio itself. So that's not quite as informative as the chart on the top, but I wanted to throw that in there. And, so with regard to the blue box reports, which I haven't particularly gone through today, I would just encourage anybody with any questions about them to please reach out to the risk time. We're happy to spend as much time as anybody wants to know on the reports, or in fact what the meaning of any of the statistics contained in the reports are. Okay.
Hold on, let's see if there's questions. You're not free yet.
Sorry, I was racing through it. I was limited to 10 minutes.
Thank you for racing through it. Any questions, or does everybody have a complete handle now on the risk of our portfolios?
Well,
If you don't have a complete handle, Mr. Katzman.
yeah, let me just give it a shot.
Okay.
So if investment were a vehicle, and if it had two steering wheels, right, and one of them was asset allocation, and the other was risk allocation, which steering wheel do I actually want to control?
Risk allocation. But that being said, it's kind of difficult to do asset allocation, a factor-based risk allocation. That's something people are only just starting to look at, and I don't know of anyone that's really implemented it yet. But you definitely need to be cognizant of it during the asset allocation process.
Any other questions? Let me just say that if this is still not crystal clear to you, we are having a trustee educational conference next Tuesday that is focused on risk. And so you can come there and you will learn more. I'm not saying you'll walk out of that completely understanding, but you will learn more and have a better understanding. So there's value in that. That's all I'll say. Your mouths are watering. There you go. Okay. Thank you, Miles. Alex, is that it for your section, or you have more?
That is it.
Okay. So I believe that concludes the public agenda that we have today. So we will now entertain motions to exit public session and enter executive session. And let's start, we'll take it in reverse order. So let's start at NYSERS. Is there a motion at NYSERS to exit public session and enter executive session?
So moved.
Thank you, Mr. Torres. Is there a second?
Second.
Thank you, Mr. Bonilla. Any discussion? All in favor of the motion at NYSERS to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, moving on to teachers. Is there a motion at teachers to exit public session and enter executive session?
So moved.
Thank you, Ms. Vickers. Is there a second?
Second.
Thank you, Ms. Penny. Any discussion? All in favor of the motion at teachers to exit public session and enter executive session, please say aye. All opposed, please say nay. Any abstentions? Okay, motion carries. Next, at police, is there a motion to exit public session and enter executive session?
Motion.
Thank you, Mr. Alejandro. Is there a second? Second. Thank you, Mr. Borelli. Any discussion? All in favor of the motion at police to exit public session and enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries at police. Next, at fire, is there a motion to exit public session and enter executive session?
Motion.
Thank you, Mr. Brown. Is there a second?
Second.
Thank you, Mr. Kelly. Any discussion? All in favor of the motion at fire to exit public session, enter executive session, please say aye. I couldn't hear that. Please say aye.
Aye.
Aye. Thank you. All opposed, please say nay. Any abstentions? Motion carries at fire. Thank you. We are now in executive session. Let's please turn the cameras off, and I would ask all members of the public and any members of the media to please exit.
A presentation from BAM and its consultants regarding numerous small cap recommendations. That discussion has been tabled. The trustees also heard from BAM and the consultants regarding the following: real estate, hedge funds, and opportunistic fixed income. The discussion on real estate was tabled. Decisions were made regarding hedge funds and opportunistic fixed income. Those decisions will be made public at the appropriate time. Thank you.
So I'd like to make a motion to adjourn?
Motion. Second.
We're adjourned.
Public session of the NYSERS caucus on March 20th, 2019.
Okay, reporting out on actions taken by the board. The board adopted a recommendation for a portfolio for small cap managers with direction to BAM, the details of which will be disclosed at a later date. The board added a manager, small cap manager, the details of which will be reported out at a later date. The board approved a pool of potential small cap managers in both Appendix A and Appendix B, the details of which will be reported out at a later date. The board voted to terminate 2 managers, the details of which will be reported out at a later date. The board agreed to 1 real estate investment, the details of which will be reported out at a later date. And the board agreed to a opportunistic fixed income investment, which will be reported out at a later date. And the board agreed to rescind a mortgage contract negotiation, the details of which will be reported out at a later date.
Okay, motion to adjourn?
So moved.
Second?
Second.
All in favor?
Aye.
We're adjourned.
In executive session, we made several allocations to various small cap managers and added several others to pool for future use. We also received a presentation from a real estate firm, consensus was reached, which will be announced at the appropriate time. We received a presentation from an OFI manager, a decision was reached, which will be announced at the appropriate time, and also a contract matter was discussed.
Do we have any business before the board today? Seeing none.
Here's the weather today.
Sunny?
Just touched the button. When you go here, you can ask.
Seeing none, I believe a motion to adjourn in order. So moved. Second by?
Second.
Okay. All in favor?
The board discussed various investment items and also and made decisions about various discussions about the investment matters. We now need a motion to adjourn.
Don't move.
Is there a second?
Second.
Thank you.
Motion.
The meeting is adjourned and see you next month. Thank you.
Good job.